The Bank of Canada's monetary policy report came out today, and in it, they dropped some hard truths on Canada's economy for 2026. Canada's inflation problem is basically solved, but the economy might be broken in other ways. Here's the story of Canada's economy in 2026. Inflation is back near target. If anything, it's below target. Interest rates are no longer the main problem for Canada's economy, but growth is still weak. Living standards are barely improving, and we know the Bank of Canada has been bringing attention to this for over a year now. With Carolyn Rogers' presentation in 2024 about Canada's productivity crisis and Tiff Macklem's recent comments that Canadians will have to accept a lower standard of living, and the Bank of Canada is quietly admitting that trade policy and population slowdown have permanently lowered Canada's economic trajectory. Their forecast for GDP growth this year is about 1.1%, and on a per person basis, so GDP per capita, basically flat. Exports they're seeing as structurally weaker. Housing is no longer a growth engine for Canada's economy. And the risks around trade, especially CUSMA, the Canada-US-Mexico trade agreement, are massive heading into Q1. Their big takeaway is this: Canada is not heading into a recession. I don't know if I agree with them on that one, but we are settling into a lower growth, lower productivity equilibrium with lower standards of living. I don't even know if most Canadians would prefer that over a recession anyways. And this is going to have huge implications for housing, for incomes, and for policy going forward. So let's get into the report. Before I start, if you want calm, data-driven breakdowns of Canada's economy and housing market, hit the subscribe button. This channel is about understanding what's actually happening in Canada's economy without bias. Okay, so let's start with inflation here. Inflation is no longer the problem. Now, I've seen a lot of doomers especially on this platform, but on a lot of platforms saying that they missed their chance to hike and inflation's going to come back with a vengeance. I would completely fade that perspective. I'm of the exact opposite. I think that if there's any risk to Canada's economy, even when we're talking about tariffs have proven to be net disinflationary or deflationary even. They reduce demand and they're bad for the economy. They're not getting passed through and becoming inflationary for Canadians. So if I were to guess on the inflation scenario for 2026, I think that the Bank of Canada is correct on this call. There's not a risk that inflation is on the high side of their target. If anything, it's going to be on the low side of their target, which would tell me we're probably at greater risk of a recession than maybe a potential stagflation or inflationary regime. And inflation has spent 2 years within the Bank of Canada's 1% to 3% target. Headline CPI is sitting at around 2.5%. Core measures are easing, which are the measures that the Bank of Canada pays the most attention to in setting their policy rate. Mortgage interest costs are finally coming down. Rent inflation is finally coming down. Energy prices are lower. Goods inflation is normalized, except for basically higher food prices, which are still being boosted by tariffs and higher input cost pressures, a bunch of stuff that's sort of outside of the scope of what Bank of Canada can control. This is the part of the situation that nobody really seems to be arguing about anymore, except for, the people who are sort of saying that we're going to see inflation come back. And I'm just going to say good luck with that call. But what comes with my call that, there's probably more downside to inflation, so that we're probably at risk of inflation being lower than 1% or lower than 2% and maybe even deflationary, is that inflation is no longer the emergency or the problem that the Bank of Canada is dealing with. Growth is the problem that Canada is dealing with. Now, the Bank of Canada even flags that some of the recent inflation bump is just a base year effect from the temporary GST holiday last winter, which I highlighted, Statistics Canada highlighted in their most recent inflation report. And I mentioned in reviewing this chart that the Bank of Canada is probably going to look through this because it's not really an accurate reading on why restaurant costs and anything GST related jumped up 8.5% on a year-over-year basis. That kind of fades the next couple of months worth of readings, and then it'll sort of taper off as that GST holiday bump goes away. Now, this chart matters more than headline CPI. CPI median and CPI trim are now running below 2% on a 3-month annualized basis. That tells you underlying inflation pressure is easing pretty quickly. And again, this would tell me that we might actually be seeing more downside on inflation and the economy is running out of steam and we're not seeing any growth. Wage growth is under 3%. Unit labor costs are modest. Import prices are stable. From the Bank of Canada's perspective, this is probably mission accomplished for them. But this creates a new problem. This is one of the most important charts in the entire report. Because of U.S. tariffs and trade uncertainty, the bank estimates that Canada's GDP will be about 1.5% lower by the end of 2026 than it would have been otherwise. And that gap doesn't close over time. Half of that loss is permanent: lower productivity, lower potential output, lower living standards for Canadians. It's not to say that we weren't already dealing with all of those things. It wasn't like, it was in 2024, Trump 2.0 and trade war 2.0 that Carolyn Rogers was talking about a productivity crisis in Canada. And even prior to that, Tiff Macklem was alluding to falling standards of living for Canadians. But, I think a lot of policymakers, politicians had kind of used the trade war and whatever it is to sort of blame that for why Canada's economy is in the dumps. I don't think the Bank of Canada is of the opinion that the trade war is exclusively to blame, but I think that they're giving it enough credit as a very real risk to making the economy far worse without belittling the mess that was made of Canada's economy and the structural issues and the non-cyclical issues with Canada's economy that have been killing us for 10 years now. And so this is basically the Bank of Canada admitting that the economy is smaller than it was supposed to be, regardless of the trade war. And so exports on excluding commodities are on a permanently lower trajectory. Businesses and Canada's government are trying to diversify away from the US, it's expensive, right? Like, you have to ship goods to places that are much further away rather than taking them across the border. And you can't really understate the cost differential that's going to happen as a result of trying to rebuild that supply chain. And it's a slow, expensive, and inefficient process to do that. Like, by the time you probably reconfigure all of that, there might be a completely different government in the US and things start to return to normal. Even though I think, Carney's speech sort of alludes to the fact that that order is breaking. I don't really know if that's necessarily the case in like sort of a post-Trump Canada-US trade relationship. Doesn't necessarily feel to me like there would be any major incentive for the US to continue keeping tariffs on Canada, similar to the way they did, say, for China, where Biden kept a lot of tariffs from Trump 1.0. And the report explicitly says that reallocating capital and labor will take years. And that's a lot of money and CapEx that gets spent to do something, or like towards the goal of doing something that you don't reap the benefit of immediately, right? So in the meantime, investment's going to stay weak. And that's a problem because Canada already struggles with investment and with productivity. And this is where the optics get a little bit misleading. So Canada's GDP grew about 1.7% in 2025. It sounds okay, but on a per person basis or per capita basis, growth was essentially zero. And this could change because now we're starting to see negative population growth. So your GDP per capita might actually start trending up in 2026, but it also might not, because in order for that to take place, GDP has to be outgrowing population. And our GDP growth could actually be so weak in 2026 that we might not actually even see a growth in GDP per capita. So the Bank of Canada assumes that population growth drops to 0.2% in 2026. And that means headline GDP growth would look weaker because, and it's funny, right? Like, because the government would have said like, it's not like population growth is being used as a tool to prop up GDP growth. It's similar, again, we've talked about this like with the carbon tax and, temporary foreign workers on wages, et cetera. They can shift the correlation and causation of the narrative to sort of suit their needs. But, now we're saying, okay, well, if all of these people are leaving, GDP growth is going to look weaker. But when we're bringing them all in, we weren't saying, oh yeah, we're doing that to keep Canada's GDP propped up at the expense of GDP per capita. But so now we've kind of got this even worse problem where before we were propping GDP up, it looked like we were growing, but on a per capita basis, individual Canadians were suffering because, the standard of living or the GDP per capita, the economy, the wealth that was getting cut up among more Canadians was shrinking. But now you've got both GDP weakening and per capita improvements remaining very modest. So consumption per person got a boost from earlier rate cuts and strong equity markets, but that, in the Bank of Canada's view, is going to fade heading into 2026. And those supports wear off, consumption growth slows. It only picks up again in 2027 as real incomes start to recover. And this translates to the Bank of Canada saying that households are cautious. They're not spending a lot of money. Now, I always thought this one was kind of funny, talking about the Bank of Canada in relation to housing. For a period of time there, I mean, I guess the April monetary policy report, so earlier this year, sort of we're in the election, we had the trade war kind of just beginning. The Bank of Canada didn't really seem to care about housing at all. And you can see that here. And the last time that they reported, so this is the number of mentions of housing in a monetary policy report. I literally would just pull up the monetary policy report, hit Command F. Here you can see there's 8. I've done this for every single monetary policy report that's been released since about 2018. And, we sort of hit a low point in April of 2025. But now it seems that they're taking an interest in housing again, right? There's an increasing amount of mentions of housing. And so when we look at their excerpt on housing here, I think actually they're a little bit too optimistic, but they're sort of looking at it like housing is still there, but it's no longer doing the heavy lifting for Canada's economy. Residential investment, they expect to grow modestly. Affordability, obviously, is a major constraint in Toronto and Vancouver. Supply is finally catching up. So we're seeing a lot of these houses, and we've been talking about this on the channel a lot. There's a lot of economic growth that's coming from the production of rental housing at the moment. Housing starts remain elevated. Supply and demand imbalances are easing, but it's not a housing-led boom cycle like we saw during the pandemic. It's more of a stabilization. This matters for investors, for builders, for governments relying on housing-driven growth, and for sectors relying on housing-driven growth, like my industry, the real estate industry, or the contracting industry. They also, I had to mention here because it feels like they just kind of drank the Remax and Royal LePage Kool-Aid, but they mentioned this pent-up demand for housing, reflecting past strength and population growth, continues to support the housing market. I just thought it was funny. You hear like the pent-up demand thing is almost like a meme at this point, right? It's like, when is this pent-up demand going to actually show up? Do we have pent-up demand, or did we not pull forward like 5 years of demand during the pandemic? And now we're just realizing its absence for like the 3 to 5 years after. And then eventually you'll get back to a normal market of demand. Like you pulled all of that demand forward into those record years of sales in 2020 and 2021 and 2022 when interest rates were super low. Where's the pent-up demand? It was all delivered back then. Anyway, it's funny because everybody talks about this pent-up demand like it's some sort of slingshot that's just going to fire the market back forward. And I have no evidence to believe that it exists. On their inflation outlook, they have inflation expected to actually dip below the target briefly, which again, this is sort of me talking about how, the bank actually expects inflation to dip below 2% temporarily in early 2026. Lower energy prices, the slowing shelter inflation that I've been talking about on the last several monetary policy report readings, the end of the GST base effect, then inflation will settle back right around target, as they say. But to me, if we're reading on the low end or we're at risk of falling below their target, that's a disinflationary, or in some sectors, even deflationary. Like the real estate industry is a good example. Like real estate is deflationary. Residential investment as a whole is deflationary. How do I define that, right? Because my outlook for the year was, yeah, sure, as it stands right now, interest rates look like they would trend up based on bond yields, based on what's happening in Canada's economy. But my outlook is that we'll probably see Q4 of 2025 will be negative GDP growth, and that's in the Bank of Canada's report. I'll see if I can get the chart up at some point. And then we'll probably have another negative quarter of GDP growth, and then we're in a recession. If you look at the real estate sector or residential investment, which is real estate and home renovations, basically, construction costs are coming way down, right? Trades are all looking for work, and realtors haven't sold. They've been selling like a third of the amount of houses or a quarter of the amount of houses that they were, the year prior and the year before that. So their commissions are down, their earnings are down. If our construction costs are down, if our trade wages are down, then what does this mean? Then that's deflationary in that sector, right? Yeah, the entire economy isn't deflationary, but there are sectors that I would argue are. And so this really reinforces the idea to me that monetary policy is now in a holding pattern. And if anything, I'm expecting holds until we see some sort of economic emergency that warrants the Bank of Canada to reconsider cuts. And I do think that we could see that based on everything that's happening right now with the trade war and especially CUSMA, which I'm going to get to now. Because the real risk here is trade and Kuzma. And it's the biggest wild card. And they spent a lot of time analyzing it in the report here. So they have this whole range of possible outcomes. And so their sort of best case is an extension with minimal changes. Their worst case is a renegotiation with annual reviews or withdrawal. Every bad outcome lowers exports, investment, and hiring. Inflation could go up or down depending on the mix of weaker demand versus higher import costs, but growth almost certainly takes a hit. So this is why they're observing it as the biggest risk to Canada's economy right now. I've been talking about this a lot on my channel. People in my comments are the ones who kind of tipped me off to it as one of the biggest risks. So thank you for that. And probably over a year ago now. But here's the bottom line. Inflation is no longer Canada's biggest problem. Rates are no longer the main constraint for growth in Canada's economy, and especially in the housing market. Housing is no longer the growth engine of Canada's economy. The challenge now is structural weakness, and we're sort of paying the price for the bad policy that we've had for the last 10 years, regardless of the trade war. Obviously, the trade war is a huge risk moving forward, but I think we're really paying the price for a bad economic setup that we've built over the last 10 years. Lower productivity, weaker trade, slowing population growth, and an economy adjusting to a smaller role in global supply. So I don't think the Bank of Canada is necessarily calling this a crisis or trying to sound the alarms, but they're certainly putting some warnings on the board. And Canada needs to focus less on demand management and more on productivity, trade resilience, and real income growth, because a stable economy that doesn't get richer is still a problem. Hit the subscribe button for weekly breakdowns. I mean, almost daily breakdowns. That's on some weeks. Really depends how I'm doing with the content creation stuff of Canada's economy and housing market. And check out the free community realist.ca if you want deeper discussions and data and just have conversations like this on a weekly basis. Let me leave you with a question. As always, thanks to the guy in my comments. I can't remember your name. I apologize. I intended to give you a proper shout out here, but I don't have it pulled up on my screen, about asking maybe a bit easier questions. And so let me leave you with a very simple question. In 2026, do you think inflation is going to go up, or do you think it's going to go down? And maybe an even easier way to frame that is, in 2026, do you think interest rates are going to go up, or do you think interest rates are going to go down? Let me know what you think in the comments. Thanks a lot for taking the time to watch this video. I really appreciate it, and I'll see you again as soon as I can.